Wall Street didn't expect it. Not this soon, not this bluntly, and certainly not in the middle of a fragile economic upswing. But the moment the former president just hinted, that he was considering replacing the Federal Reserve chair, the financial world reacted as if someone had pulled the emergency brake on a speeding train. Screens across trading floors flashed red. Futures swung violently. Analysts who had spent months projecting a gradual cooling of the markets suddenly found themselves rewriting their morning notes in real time. And then came the response. Jerome Powell, a man known for discipline, restraint, and carefully measured language, issued a warning that landed like a shockwave. Stability is not guaranteed, and independence of the Federal Reserve is not optional. His words were precise, but the subtext was unmistakable. Political interference at this moment could fracture the delicate balance holding the economy together. Within hours, banks, hedge funds, and global exchanges were modeling scenarios they had hoped to never revisit. Investors weren't just reacting to the possibility of a new Fed chair. They were reacting to what that possibility implied: uncertainty, unpredictability, and a potential shift in the very philosophy guiding American monetary policy. And while most of Washington stayed silent, one voice watching from the sidelines framed the moment with stark clarity. Markets don't fear change, they fear chaos. And chaos, once triggered, moves faster than anyone can control. The reaction inside financial circles didn't build slowly. It hit all at once, sharp, immediate, and unmistakable. The hint about replacing the Fed chair wasn't delivered through a formal speech or economic briefing. It emerged casually, almost offhand, during an interview where the former president suggested the Federal Reserve needed new leadership, new thinking, and someone aligned with America's growth instead of slowing it down. The comment lasted mere seconds. The consequences rippled for hours. Within minutes, major banks activated internal risk teams. It wasn't just the fear of who the new chair might be. It was what the change symbolized: a break in continuity at the exact moment markets were attempting to stabilize after months of uneven data. Traders who had been watching inflation ease and labor markets cool suddenly found themselves staring at a potential shift in the entire philosophy guiding monetary policy. Stability depends not only on decisions, but on predictability, and predictability had just been thrown off course. At the same time, Powell chose not to stay behind the curtain. His warning, though brief, was unusually direct for a Federal Reserve chair. He emphasized the importance of independence, the dangers of sudden leadership shifts, and the risks inherent in tying monetary policy to political cycles. He didn't name anyone. He didn't need to. His message reached Wall Street with absolute clarity. The central bank was bracing for turbulence, and Powell was preparing to defend its autonomy. Investors know how to read between lines. They could sense what wasn't being said. If the Fed chair was publicly drawing boundaries, something larger was unfolding behind the scenes. Analysts across major firms began telling clients to expect volatility until the political landscape became clearer. Some described the moment as the most precarious political financial collision since the early pandemic era. The uncertainty didn't stop at markets. Corporate executives, especially in sectors sensitive to interest rate behavior, real estate, automotive, tech, started recalibrating expectations. Just as they were adjusting to the likelihood of slower rate cuts, they now had to model a scenario in which a new Fed leader might accelerate or reverse policy altogether. CEOs on earnings calls were asked about the possibility of political influence over monetary policy. Few offered direct answers, but the tension behind their measured responses was obvious. Meanwhile, inside Washington, the reaction was fractured. Some lawmakers aligned with the former president celebrated the remark, arguing that Powell's cautious approach had hindered American growth. Others, including members of the same party, quietly expressed concern that tampering with the Fed's independence could spook global markets already wary of U.S. political unpredictability. No official confrontation took place, but staffers inside Senate offices said the phones lit up almost immediately with questions from donors, business groups, and state leaders trying to understand what had just been set in motion. What stunned observers most was the timing. The economy was in a delicate transitional phase, cooling just enough to ease inflation concerns, yet stable enough to avoid recession. The markets had begun to accept the Fed's slow, methodical path forward. And then, without warning, that balance was disrupted by a single political sentence. Powell's warning shifted the tone but did not calm the turbulence. Instead, it added weight to an emerging sense that a confrontation was forming between the political sphere and the financial establishment. Some analysts described it as a philosophical standoff. One vision focused on aggressive growth at any cost, the other on stability, credibility, and long-term resilience. Executives in Silicon Valley and major investment firms privately noted that the scenario mirrored past international crises where political influence threatened central banks. In those cases, economies didn't collapse, but they did wobble, confidence shook, and foreign investors became cautious. The U.S. had long been exempt from such concerns because of its deeply rooted institutional independence. Now, for the first time in years, that foundation appeared vulnerable. But while the political world debated consequences and Wall Street recalibrated its models, ordinary Americans felt the ripple in far simpler terms. Mortgage rates twitched upward, retirement accounts dipped, credit markets tightened. Even small business lenders held back approvals, waiting for clarity that might not come soon. The day ended not with answers, but with questions that echoed across trading desks, think tanks, and corporate boardrooms. Would there be a new Fed chair? Would Powell stay and fight? Would the market stabilize or escalate? And what would happen if politics pushed deeper into the central bank than ever before? No one had answers yet. But everyone understood one thing. The stability of the world's largest economy now hinged not on inflation numbers, not on job reports, but on a political signal that had opened the door to the most unpredictable chapter in recent monetary history. The hours after the market turmoil brought a different kind of volatility, one that didn't show up on charts or indices, but inside the institutions that usually move quietly in the background. Major financial regulators held late-night conference calls, comparing notes on liquidity, credit flows, and stress points. None of them wanted to signal alarm publicly, but the very fact that these conversations were happening revealed how seriously they viewed the political threat to the Fed's independence. Behind closed doors, senior officials admitted a truth they rarely say out loud. Stability is not built only on data, it's built on faith. Faith that institutions will behave consistently, that rules won't shift overnight, and that central banks won't be pushed into political cycles. If investors sense that faith wobbling, even slightly, the reaction can snowball in unpredictable ways. And that wobble had already begun. Global markets reacted next. London opened sharply lower, Tokyo followed with caution, and European officials privately questioned whether the U.S. was heading toward its most significant central bank conflict since the 1970s. When America's monetary policy becomes uncertain, the entire financial world recalibrates. Foreign investors began repositioning portfolios, bracing for currency volatility. Some funds even shifted into gold, an old signal that uncertainty had reached a threshold. Inside the Federal Reserve itself, the atmosphere turned more disciplined, more focused, almost militaristic. Staff analysts worked through the night to simulate how different leadership scenarios would alter interest rates, balance sheet plans, and inflation trajectories. Senior officials attempted to reassure regional banks that the Fed stood united. They emphasized continuity, stability, independence. But they could only say so much without provoking the very political confrontation they hoped to avoid. Powell's closest advisors understood the risk he had taken by issuing a public warning. Fed chairs don't speak sharply unless they're signaling something critical. His words were calibrated to avoid escalation while making one point unmistakable. Monetary policy must not become a political weapon. But to some political strategists in the former president's orbit, that stance was precisely the problem. They argued that Powell represented the old guard, too cautious, too academic, too willing to slow growth in the name of stability. Their vision was more aggressive: cut rates faster, stimulate markets harder, and push the economy into overdrive. This clash of visions accelerated chatter inside Washington. Some Republican lawmakers quietly floated potential replacements, names of economists, business leaders, even political loyalists who they believed would align more closely with a growth-at-all-costs approach. None of these names had central banking experience. That worried those who understood the complexity of the system. Replacing the chair with someone untested could jolt markets far worse than the initial comment had. Yet the idea gained momentum among certain factions who viewed the Fed not as an independent institution, but as a barrier to their preferred economic agenda. For them, Powell's warning wasn't a stabilizing message, it was defiance. Corporate America took a more cautious view. CEOs and CFOs across multiple industries agreed privately that Powell's measured approach had prevented a recession the previous year. They knew the risks of moving too quickly, too politically, but few were willing to say so publicly, fearing backlash from a political environment that punished dissent. At the same time, Elon Musk, whose public comments often reshape online discourse, posted a cryptic remark about markets craving clarity, not chaos. He didn't take sides, but the statement circulated widely. Analysts debated whether he was signaling support for Powell's discipline or urging the political world to provide a clear direction. Musk's comments tend to amplify whatever tension already exists, and this time was no different. Meanwhile, American households continued to feel the tremors in subtle ways. Credit card rates ticked upward as lenders priced in new uncertainty. Mortgage brokers reported a surge in applications from buyers trying to lock in rates before further instability. Home builders paused new projects until borrowing conditions became clearer. Even auto dealers noticed a shift. Customers hesitated to commit to loans that might soon cost them more each month. Then came the worst sign of all. Uncertainty began infecting business hiring plans. When companies don't know what the next 6 months will look like, they slow expansion. They freeze hiring. They delay investments. The job market didn't collapse, but its momentum faltered, and economists recognized the pattern instantly. Uncertainty is a tax, and this tax was growing. Back in Washington, the conflict deepened. Allies of the former president escalated their criticism of Powell, framing him as resistant to prosperity. Powell's defenders argued that economic prosperity doesn't survive without institutional integrity. One side was pushing for acceleration. The other was fighting to keep the engine from overheating. By week's end, the political world understood something the markets had sensed immediately. This was no longer just a comment or a rumor. It was now an ideological confrontation, one that could reshape the future of America's monetary system. And the question hanging over every boardroom, trading desk, and policy meeting was the same. If replacing the Fed chair is the opening shot, what comes next? What came next was a scramble for interpretation, an all-out sprint by analysts, political strategists, and international observers to decode the true intentions behind the former president's hint. Was it a trial balloon? A warning shot? A serious plan already in motion? Or simply a moment of improvisation that spiraled into global concern? No one had a definitive answer, and that ambiguity became fuel for further instability. Cable networks hosted emergency panels. Economists appeared on morning shows with graphs that looked increasingly shaky. Market commentary grew more speculative. Meanwhile, social media turned the Fed chair into a trending figure overnight. with millions of people who had never discussed monetary policy suddenly debating central bank independence. The moment had crossed out of elite economic circles and into the mainstream, always a sign that the stakes had widened. Powell, for his part, maintained a deliberate calm. His public schedule remained unchanged. He appeared at a scheduled economic forum, spoke slowly, kept his tone measured, and avoided political references. But his body language, slightly more rigid, slightly more pointed in his emphasis on institutional continuity, signaled to those watching closely that he was preparing for a drawn-out confrontation. Behind the scenes, global financial leaders began reaching out to the Federal Reserve for reassurance. Officials from Europe, Asia, and the Middle East wanted clarity. Was Powell staying? Was the U.S. drifting toward politicized monetary policy? Would the dollar face new volatility? Every conversation carried the same subtext. If the world loses confidence in the Fed, the repercussions won't stop at American borders. Inside Wall Street's largest firms, something subtler began happening. Risk models were rewritten not just to account for interest rate uncertainty, but for political unpredictability. Analysts started bundling political volatility into long-term forecasts. Senior strategists warned their clients that the U.S., once the anchor of global financial consistency, was showing signs of becoming a variable instead of a constant. That shift was historic. Meanwhile, the former president continued speaking confidently about his ability to reshape American economic leadership. Supporters praised the idea of fresh direction. But economists who once advised his administration privately worried that removing Powell mid-cycle could trigger a crisis far worse than any short-term inflation pressures. Some attempted to communicate these concerns discreetly, though few were convinced they would alter the political calculus. As the narrative fractured, corporate America became increasingly vocal. Tech giants, industrial conglomerates, and major financial institutions released statements emphasizing the importance of central bank independence, carefully worded but unmistakable in their message. The business world was choosing stability. For everyday Americans, the situation felt more immediate than the political debate. Markets whipsawed, sometimes violently. The cost of borrowing ticked upward. Investment portfolios swung unpredictably. Small business owners began calling their banks, hoping for answers lenders didn't have. Even those not focused on financial news could feel something shifting beneath the surface. Among all the swirling uncertainty, one question dominated. If Powell were replaced, who would take the job? Names circulated, some respected economists, some political loyalists, some complete wild cards whose ideological alignment mattered more than their expertise. None of the possibilities reassured the markets. And as the speculation intensified, Powell's warning, his single, carefully calibrated message, took on a new weight. Independence is not optional. Stability is not guaranteed. And Wall Street, Washington, and the world were beginning to understand exactly what he meant. The pressure that had been building beneath the surface finally began to reshape Washington itself. Quiet conversations turned into strategic maneuvers, and the question of whether the former president might actually move to replace the Fed chair evolved from speculation into a tangible political scenario. Senior advisors floated trial messages to test public reactions. Donors in the financial sector pressed lawmakers for clarity. Even members of Congress who rarely commented on monetary policy found themselves being interviewed about central bank independence. It was no longer a hypothetical crisis. It was an unfolding one. Inside the White House orbit, two competing forces began to emerge. One faction argued that replacing the Fed chair would send a bold message of economic revitalization, signaling a new era of aggressive growth. They believed the markets would adjust quickly once the decision was formalized, framing volatility as temporary noise rather than structural instability. Their argument was simple. If rate cuts aren't happening fast enough, change the person controlling them. The other faction, more cautious and steeped in financial experience, warned that tampering with the central bank at this moment would unleash a global wave of uncertainty. They reminded allies that the US dollar serves as the world's reserve currency, and its stability relies on faith in the Federal Reserve being insulated from politics. Undermining that insulation, even symbolically, could have consequences that far outweigh any short-term political boost. Meanwhile, Powell's allies within the Federal Reserve System began preparing for the worst-case scenario. Regional presidents drafted contingency plans for maintaining operational continuity if the leadership changed abruptly. Internal memos reassured staff that the institution had survived political storms before and would survive this one, too. But the tone of those memos, polite, procedural, measured, could not entirely hide the underlying tension. When the independence of the Fed is threatened, even indirectly, the weight of history presses down on every word. The world outside Washington felt the strain as well. Foreign central banks kept a close eye on U.S. Treasury yields. Investors in Europe began hedging against a potential weakening of the dollar. Emerging markets, always sensitive to American policy shifts, prepared for capital outflows. International headlines captured the global mood. Is the U.S. politicizing its central bank? The mere possibility created a new kind of geopolitical unease, one rooted not in diplomacy or military conflict, but in monetary credibility. Economic historians compared the moment to past crises triggered by political interference in central banks across the world. In those cases, the patterns were eerily familiar. Falling investor confidence, rising borrowing costs, credit tightening, and a slow erosion of institutional authority. The United States had long been held up as the example of how an independent central bank stabilizes an economy through shocks. Now that independence was being questioned, even if symbolically, financial analysts warned that the U.S. risked losing one of its greatest advantages, the assumption that its institutions were beyond political manipulation. In corporate boardrooms, the conversation shifted from, will things calm down, to how do we prepare if they don't? CFOs and treasurers reevaluated debt exposure. Companies with international operations began exploring currency hedges. Investment committees debated delaying major acquisitions until the political picture became clearer. Even firms planning domestic expansions hesitated. Strategic caution became the default position. Amid this growing tension, Powell continued his careful public posture. He made no overt political statements, but each time he spoke, his emphasis on credibility, consistency, and the long-term health of the economy sharpened. Observers noticed subtle elements of resolve, an awareness that the coming months might test him in ways few modern Fed chairs had been tested. Those who had followed his career understood that Powell was not positioning himself politically, he was defending the institution. Meanwhile, the former president's comments ignited a fierce media battle. Supporters framed him as a decisive leader unafraid to challenge entrenched systems. Critics accused him of endangering economic stability for political gain. The debate spilled onto financial networks, where economists argued over whether the Fed had been too slow to cut rates or whether its caution was essential to preventing another inflation spike. Retail investors, a group increasingly influential in the digital era, reacted emotionally rather than analytically. Online trading forums exploded with speculation. Some believed a new Fed chair would send markets soaring. Others feared a crash. The conflicting narratives added confusion to an already volatile environment. But the most striking development came from a coalition of governors and state financial officers who expressed concern about the destabilizing effect of the uncertainty. They released statements emphasizing the importance of a consistent monetary framework, especially as states navigated unpredictable housing markets, shifting credit conditions, and sensitive regional economies. These weren't partisan attacks. They were pragmatic warnings from leaders responsible for balancing budgets and safeguarding local economies. Through all of this, the stock market continued its turbulent oscillation. Sharp gains one morning were erased by sharper losses the next. Analysts described the behavior as uncertainty-driven volatility, a polite term for a market struggling to price in political risk. Even experienced traders admitted that the math had changed. When politics influences the Fed, models break down. And yet, at the center of this storm was a simple truth the financial world couldn't ignore. The question wasn't merely who would lead the Federal Reserve, but whether the institution itself would remain insulated from political agendas. That question carried implications far beyond interest rates, and everyone watching understood that the answer could define the next decade of American economic performance. The conflict was no longer simmering. It was escalating, and the calm voice of the Fed chair, against the rising noise of political ambition, had become the defining tension of the moment. As the year approached its final stretch, the standoff between political ambition and institutional stability reached a point where neither side could afford to retreat. Markets had grown accustomed to volatility, but investors sensed that the next move, whoever made it, could decide the trajectory of the entire economy. Confidence had become the most valuable commodity, and it was in increasingly short supply. Inside the Federal Reserve, Powell continued reinforcing the same message. The institution's credibility must be protected at all costs. His speeches grew firmer, his language sharper, though still wrapped in the professionalism expected of a central banker. He refused to engage politically, but every sentence carried the weight of someone who understood the stakes. A destabilized Fed wasn't just a policy risk, it was a generational risk. The former president, meanwhile, continued hinting at change, promising leadership that would unleash growth and finally put America back in control of its own economy. Supporters applauded the vision. Critics warned that no economy thrives when its central bank is drafted into political combat. Financial leaders, lawmakers, and state officials urged caution, some publicly, many privately. They warned that uncertainty was already slowing hiring, tightening lending, and reshaping long-term planning. But the political momentum surrounding the idea of a new Fed chair had taken on a life of its own, propelled as much by messaging as by policy. For ordinary Americans, the noise translated into one unsettling reality. Their mortgages, their retirement accounts, their savings, all of it now hinged on a political decision that could rewrite the rules of the most powerful financial institution in the world. The final question lingered over every discussion, every interview, every trading floor whisper. If the independence of the Fed falters now, what foundation does the economy stand on tomorrow? Thank you for watching this video. Click here to watch another video that might interest you.